Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. The Bank of England has just released the results of its 2025 stress test. In their nightmare scenario, inflation surges, house prices tumble, markets tank, and all 7 major UK banks still pass. So the financial system might survive a crash, but would you?
I want to know how to ride out the apocalypse. And in today's dumb question of the week, are British banks too big? All right, let's get into it. So I think what everybody needs in the run-up to Christmas is more stress. And here we are. The Bank of England has laid it on thick with the 2025 stress test, designed to measure whether banks have got a big enough safety cushion to weather a severe economic storm. So I thought today, Roman, we'll go through what that stress test is, why the banks look like they are safe enough, and what it would mean for us as investors were this scenario to play out.
Yeah, maybe a good place to start is to say that actually this is to avoid stress. If you've got fair confidence in the banks, then we can weather some of these political storms, some of these economic storms, and hopefully sail through it without too much damage to the economy.
That's one way to do it. The other way is to just bury your head in the sand and hope for the best. Tried and true strategy, that is.
But all of the major central banks do these stress tests, and really you have to do it, I think, in order to gauge whether everything's okay and whether if you did shock things, there would be some obvious problems. Because if you ask a bank, is everything okay? Well, of course, they're going to say, yeah, everything's fine. You know, we're a brilliant management team. Everything's under control. We've got a fantastic compliance department. They're never going to say, look, here are the time bombs on our balance sheet.
Yeah. Banks will say that on the eve of a crisis, even where their share price is tanking. They'll go on Bloomberg TV and go, everything's fine, guys.
So really, this is a chance for the Bank of England to kind of poke the hornet's nest and really try to work out whether these banks can weather these storms.
Can I start with the Bank of England's disclaimer, which is right at the top of their stress test? Let me just read it. The stress test scenario is not a forecast of macroeconomic and financial conditions. Rather, it is intended to be a coherent tail risk scenario designed to be severe and broad enough to allow regulators to assess the resilience of UK banks to a range of adverse shocks. It is not a set of events that is expected or likely to materialise.
But you can see the difficulty straight away in that language. How severe do you make it? Do you make it apocalyptic, or do you make it just a bad year? You know, what's the severity that you're going to stress the banks with? So there is a huge degree of subjectivity about how bad the stress test is, and also there's a kind of secondary uncertainty about whether the actual implications have been calculated correctly.
Well, they say that the stress test scenario is designed to be severe but plausible. And if you read the document, the comparisons they often make are to the global financial crisis in 2007, 2008. And they want it to be of a similar scale, I think. That kind of once in a generation, everything's blowing up kind of event.
So let's go through this wargaming scenario just to see exactly what the shock is. Primarily, the 2025 stress test is about a severe global aggregate supply shock. And the consequence of that would be deep recessions, which would be global in nature. Now, alongside that, you'd probably get rising geopolitical tensions, because if you do get these stressed economic situations, you often get that as a kind of co-symptom. I'm not sure what you'd call it.
And we've seen supply shocks recently, haven't we? Coming out of COVID was definitely a supply shock, and that helped cause rampant inflation.
And the classic one would be a war in the Middle East, right? You get some kind of war flaring up. These countries supply a lot of the energy products that we use, oil, gas, and that means that you get a huge surge in the price of those commodities. And for the UK, which imports a lot of energy, that's going to be a huge problem for our economy because our input costs increase. Because to first order, the UK economy imports oil and exports services.
I guess you could say in their stress test, that's kind of the catalyst. So they're modelling a scenario where oil prices rise by over 100% and gas prices rise by over 300%. And it says to levels comparable with those experienced during the peak of 2022, which, remember, were extreme and had they lasted would have been catastrophic.
Now, they're always saying that the UK is an open economy. What does that actually mean? Well, we depend heavily on trade. And so if there is a breakdown in global trading relationships, which is what they're predicting, that's what they're saying is going to create these supply chain disruptions. So there's going to be a huge fall in global trade volumes. In fact, they say it's going to be 20%, which is absolutely huge.
And we should say again, this is not a prediction. This is just what the stress test scenario is modelling.
Now, the obvious impact of that would be a sharp rise in inflation, and that'll be across all advanced economies. And central banks would raise interest rates to try and get inflation back to target.
So if we focus on the UK, the stress test scenario has inflation peaking at 10%, and consequently bank rate, i.e. the policy rate of the Bank of England, being increased to 8%.
So let's just look at the context for that. If we go back in time to look at UK inflation, the last time it spiked that high was 11.1%, and that was in October of 2022. And of course, that was the post-COVID spike. If we go back even further, it reached a peak of about 8.4% in 1991. And then if we look at bank rate, we'd have to go all the way back to 1992 when it was above 8%. So these are very severe moves.
Something a lot of us won't remember or have even seen in our lifetimes, maybe, for our younger listeners, when it comes to bank rate anyway.
Now, of course, if you have that kind of scenario, it's also going to affect growth. And what they're expecting is severe domestic recession in the UK, with a big fall in GDP. So real GDP is going to fall by 5%. And unemployment, which is what really hurts, because if you lose your job, obviously that's a huge economic blow for a family. They expect unemployment to double to 8.5% in the third year of this scenario. And that's comparable with what we saw in the GFC.
Now, I know what everyone's thinking. GDP is going down, recession, inflation's going up. Yeah. What about house prices? What's going to happen to those?
Now, I've often said that house prices track things like wage growth, and they are very economically sensitive. So if there were big increases in unemployment, weakening of growth, they expect house prices to fall by 28%.
Ooh, that's a painful blow. That's in nominal terms too, while inflation's running at 10%.
Yeah, so very painful for homeowners, very painful in terms of invested assets, I assume.
Oh yeah, asset prices are coming down massively in this scenario. So the stress test has the FTSE All-Share Index falling by 48% and the S&P 500 falling by 57%. Which is kind of comparable to the global financial crisis, peak to trough.
Now, the thing that the Bank of England really worries about is the effect on banks. And if it is the case that banks are going to suffer through this crisis, which of course they would, how much will they be able to lend to the real economy to get things going again? Because it's that pullback in lending which kind of amplifies a lot of this economic pain. Because if companies can't borrow to invest, then that means that that's going to weaken economic activity further. So there is a kind of multiplier effect there. Now, there is a really important ratio here called the CET1, or the Common Equity Tier 1 capital ratio. So think of the balance sheet of a bank like a kind of shock absorber. Now, it does have capital which can absorb losses, and that is equity-like capital. So the more equity-like capital which the bank has, when the value of the assets falls by a certain amount, you shrink the size of the equity. But if you shrink it to zero or beyond, essentially the bank is bankrupt. So what's really important is to keep those CET1 ratios reasonably healthy. Banks don't like it because it reduces their profitability. The more leverage the bank has, the more it can lend, the bigger its revenue.
The bigger its bonuses, right?
That's right.
Isn't that the real issue?
Yeah, it is. And so, that's why we need regulators to stop banks falling into this trap of having too much leverage. So the CET1 ratio is very important.
It's the capital buffers, basically.
Now, just to give you a feeling of what's a normal CET1, it's just under 15% in good times. And if we go back to 2007, it was at around 4%, maybe 5%. So they've got much bigger buffers than they did in the past. And that's deliberate, right? They've constructed this risk measure and then they've made sure that the banks build up those capital ratios during good times.
Now, as a result of this catastrophic scenario they're testing against, the CET1 ratio in aggregate would fall by 3.5 percentage points and reach a low of around 11%. But the good news is, the banks are still solvent and they pass with flying colours.
Hooray! So everything's fine.
Yeah, kind of. My thing is, it really depends on the specifics of what they're modelling. Because if you drill into, well, why have they passed? Surely they're having huge losses when the equity market falls by half. Commercial real estate crashes as well. A lot of their loan book goes bad. And if you look at it, they're taking nearly 6 percentage point losses here. But they're saved by the fact their net interest income rises significantly because bank rate goes up to 8%.
Now, if you're a bank, to first order, what they do is maturity transformation. What they do is they borrow at the short end of the curve and then they lend out at the longer end of the curve. So that's why the shape of the yield curve is very important for banks, because of this transformation of the period of lending and borrowing. But it also means they're subject to a risk, which is that difference decreases and their NIM, their net interest margin, falls.
This scenario that they're modelling is very different to the global financial crisis, where interest rates basically fell to zero and we had very weak inflation. This is kind of the opposite. It's more like stagflation. And the banks kind of come out of that okay. In fact, so well that the Bank of England has decided to lower the system-wide Tier 1 capital benchmark from around 14% to 13%. So they're giving the banks a bit more leeway to lend money.
Now, of course, in the UK, the problem we've got at the moment is very weak growth. So in theory, this should help stimulate growth in the UK economy. It should make it easier to lend. Hopefully, that's going to provide a little bit of a stimulus for the UK economy.
Now, this stress test looked at the 7 major UK banks. And as we said, they all passed. And they're going to be allowed to keep slightly lower capital buffers in the future. But what really matters is the specifics of the scenario and how it affects each individual bank. And when you read the Bank of England report, it's quite clear that they're aware of that. So they make a big deal about Hong Kong real estate. And you might think, well, that's a bit weird. That's on the other side of the world. Who cares about that? It's such a tiny market. But I think they flag it because, well, one, it's a massive fall, so almost 70% drop in the value of Hong Kong real estate. And I think the second point is HSBC does a lot of business in that part of the world.
Yeah, in fact, if you look at shock scenarios where you look at the effect of the Chinese economy on the UK economy, one of the transmission mechanisms is HSBC's balance sheet because of that reason. So that's an idiosyncratic risk for that particular bank. And presumably, each of us individually would also have our own idiosyncratic risks. We'd be differentially affected by this kind of crisis.
Romin, that's the perfect lead into the break, because in the second half, I really want to talk about, it's fine that the banks are going to survive, but are we going to survive? Who's going to be most affected? Who's going to be most exposed? And what can we do about it?
Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Trading 212 Stocks and Shares ISA is the cheapest way to invest, with zero commission and one of the lowest FX fees I could find on the market. Looking to keep things simple, you can easily automate your investing with pies that allow you to rebalance your portfolio at the click of a button. Customers with Invest accounts can also benefit from the Trading 212 card, which has no FX fees, true interbank rates, and offers 1.5% cashback on all transactions up to £15 per month. Many Happy Returns listeners can claim free fractional shares worth up to £100. Just create and verify a Trading 212 Invest or Stocks ISA account, make a minimum deposit of £1 and use the promo code ROMIN, RAMIN, within 10 days of signing up, or use the link in the show notes. When investing, your capital is at risk and you may get back less than invested. Past performance doesn't guarantee future results. Pies and Autoinvest is an execution-only service, not investment advice or portfolio management. Automatic investing refers to executing scheduled deposits. You are responsible for all investment and rebalancing decisions. Free shares can be fractional. 212 cards are issued by Paynetics, which provide all payment services. Trading 212 provides customer support and user interface. Terms and fees apply.
Okay, so in the first half, we looked at the stress test scenario for 2025 and how it impacts the banks. And, it takes a big chunk out of the bank's capital buffers, but they do pass the stress test and they are able to keep lending through an economic shock like this. But needless to say, such a catastrophic event would affect everyone, but not everyone equally. Some people are obviously going to suffer a worse outcome. So who do you think would be worst hit by a scenario like this?
Well, if we're going to get doubling in unemployment, then presumably the families where somebody loses their job are going to be the ones which are primarily affected. And often it's not because of your own particular problems or because you haven't been performing well at work. It's simply that the company you work for has less demand for its goods and services, so they've just got to lay off people. So there is an element of randomness about it. So if you do lose your job, don't necessarily feel bad about it. I know it's pretty cold comfort, but if it's because of a pullback in the economy, then that might be the primary reason. Particularly if you work in one of those cyclical industries, which are very much affected by a slowdown in economic activity. If you work for Tesco's, well, people still have to eat.
But you saw this, didn't you, working in the financial services industry during the global financial crisis? People were just disappearing week by week, right, across the investment bank.
Yeah, it was entire desks would just disappear overnight. And you just walk down the stairs and where are all my friends? I just wanted to have a chat, but they'd gone.
What's happened to all those cardboard boxes that were in the corner?
That's right. So banks are very cyclical and it was just part of the job. You had very little job security. I won't say people were expecting it, but you never think it's going to happen to you. But eventually it did happen to me as well.
Yeah. Comes to everyone, I think.
But other cyclical sectors would include things like construction and the property market generally. So estate agents would be affected by falling house prices. Any kind of discretionary retail, so more expensive brands which people would cut back on. All those speculative tech things, people would probably cut back on that as well.
I think there'd just be less money sloshing about, wouldn't there, for speculative tech? It relies on VC firms willing to lose money for quite a number of years. People are probably less willing to lose money when their portfolio is already down 50%.
And of course, things like cryptocurrency. If you haven't got money to save, you're not going to put it into a speculative asset.
But you're definitely right that the biggest impact people would feel is if they lost their job. And that's a huge concentration risk. We talk about concentration risk in terms of your portfolio, but most people only have one job and one source of income. So obviously losing that is devastating if you can't find something else. But it's not just those unlucky people who'd be affected by a doubling of unemployment. In that kind of scenario, wage growth is almost certain to stall and promotions will be harder to come by. So everybody is probably going to suffer relatively lower income to where they would have been had this not happened.
Yeah, if there's more slack in the labour market, then negotiating a higher wage is going to be very difficult indeed. So you would expect wage growth to slow down as well.
And obviously that's what we did see after the global financial crisis for a long time.
Now, one thing we've probably forgotten is a world in which we've got negative equity. You borrow in order to buy a house. Some people have borrowed a lot, maybe too much in good times. And then when house prices fall, instead of a leverage gain, you've got a leverage loss. And that can be incredibly painful because you may be locked into that house and you can't move.
And if you can't service the mortgage, then obviously you might lose the house.
So I wouldn't underestimate the amount of pain that this could cause. And I think very few people would think, well, it's okay. My bank passed the stress test. I know I'm losing the house, but my bank's fine.
At least I'm losing it to the bank. I'm helping them pass the stress test. Here's the keys. In this scenario, they're saying a 28% fall in British house prices on average. That would presumably tip quite a lot of people into negative equity. So the obvious people that I think would be at risk is anyone who bought recently with like a 10 to 20% deposit would immediately be put into negative equity. Their outstanding mortgage would be more than the value of their house. And there you are, just really hoping you can wait it out if you haven't got like enough cash set aside as a buffer. As a tier 1 personal buffer.
And I think this is also bad for the generational divide because many of the people who own their house outright are the people who've been paying off their mortgage for many, many years and who've now paid it off completely. Whereas younger people are still leveraged. They've still got large mortgage payments to make. They probably don't have many savings. So these are the people who are going to be massively negatively affected.
Especially because at the same time as you get this almost 30% fall in the housing market, you've got bank rate, doubling to 8%. Now, if you work out what that means in terms of mortgage payments, you've got to add on a bit of bank margin. So let's say a 10% mortgage rate. That's a big increase from where we are today. And I don't think people could handle that.
Now, in the UK, effectively what we have is a floating rate market when it comes to mortgages. In the US, they've got 20-year fixed mortgages, 30-year fixed mortgages. In the UK, we only usually fix for around 2, maybe even 5 years. So really, again, this comes down to a matter of luck. When did you fix your mortgage and how long did you fix it for? And if you are one of the unlucky ones where you fixed it such that you're just about to come to the end of your term, then you're in big trouble.
Yeah, if you run headfirst into the 8% bank rate at the worst time for you, it's going to put severe strain on your finances. We kind of saw that after COVID. Obviously, it didn't go as high as 8%, but there was that element of luck of the draw. When did you need to face the market again in terms of fixing your mortgage? And there are still people who haven't had to do that yet. If you look at the Bank of England's financial stability reports, they always stress that there's more people who are going to have to refix their mortgages in the coming years and pick up those higher interest rates.
And the arrears rate is pretty low. So in Q3 of 2025, it was 0.9%. So again, I don't think we remember a world in which you get these big pickups in repossessions and how much pain that causes for a family. What's also interesting is the Bank of England points out that for renters, this is going to be a very painful scenario. So they look at the gap in median savings to income between outright owners and renters, and they say that's widened over the course of 2025. So while it is the case that rental price inflation is likely to fall, and that should somewhat ease pressures on renters, they also continue to be more likely to report financial difficulty, and they're more likely to have insufficient emergency savings. And given that around a third of UK households are renters, then this slice of the UK populace is likely to suffer a lot.
And I suppose in this stress test scenario, you really wouldn't want to be a landlord with a 30% house price crash, interest rates going through the roof. You know, a lot of landlords are quite highly leveraged on interest-only mortgages. If you're looking for repossessions, it could come from that slice of the market rather than owners.
And if the tenants can't afford to pay rent increases or pay rent at all, then again, that's going to be a problem.
But it's not all about the housing market, is it? As we said, stock markets are falling like 50% in this supply shock. And I suppose that will worst hit people who need to sell their stocks during the crash.
Yeah, so if you're in retirement and your portfolio is heavily tilted towards equity, well, there are only so many bonds you can sell before you start eating into that depressed equity. And that effectively means that you're going to be depleting your pension pot at a higher rate.
Well, you mentioned selling bonds. Maybe this isn't even the time to sell bonds if interest rates have jumped up to 8%. You know, it depends on the duration you've got, but a 60-40 portfolio is going to fail badly if you're holding intermediate or long duration bonds for that 40%.
Wouldn't it be a pity if ISAs only allowed you to buy longer duration bonds? Oh, wait a minute. Isn't that what the budget's just talking about? Not that I'm angry about that. I'm very angry.
I feel like it's going to be a repeated motif for the next 6 months on the podcast. Anytime the word duration is mentioned.
Well, at the moment, I've got zero duration effectively, or very low duration, because my 40% is in money market funds. But if I'm pushed out of them, I won't have that safety.
But traditionally, a 60-40 portfolio is not holding zero duration as the 40. It's holding maybe intermediate length, 10-year government bonds.
Yeah, it would have some kind of aggregate bond index type of allocation, which would be around 7 years maturity, 8 years, something like that, which would be negatively impacted, coming back to our theme.
How bad would it be? Let's say interest rates are around 4% now and they jump to 8%. What loss are you looking at on a 10-year government bond?
Well, if the effective duration is 7 years and rates have increased by 4 percentage points, well, 7 times 4, that's not going to be pleasant. Just under 30% fall in the value of the bonds.
So this scenario where you get high inflation and a jump in interest rates is bad for equity, it's bad for bonds, it's obviously bad for house prices too. Is there anything out there that you think might save people in their portfolio if this played out?
We talked about zero duration things like money market funds, those are going to be less impacted. Cash will be less impacted. It's only affected by inflation. Gold is the one that people often talk about. Another one might be commodities. Commodities sometimes hold up in this kind of scenario.
Well, in this scenario, it looks like it really would hold up, right? If you've got energy costs jumping up. So what was it? Oil prices up 100%, gas up 300%. You own a commodity fund or maybe even just energy stocks. That's presumably the diversifier you'd want to hold here.
Yeah, and that return stacked portfolio, what I ended up with was levered 60-40 combined with gold and broad commodities. So those two components would probably hold up pretty well. Clearly, the levered 60-40 would get crushed, but it's not the whole portfolio. It's only 2/3 of it.
But should people be focusing on a scenario like this and thinking, well, I better add commodities and energy stocks and gold to my portfolio just in case the Bank of England's nightmare scenario unfolds, even though that disclaimer at the top said these events are unlikely to materialize?
I think it's going to make people too cautious. I think it's the same with asset allocation. If you build your asset allocation on worst outcome scenarios and you have a portfolio that can handle any tail risk, well, it won't have enough risky assets in it. And that's going to affect your long-term return. So it's always a matter of balance. What's the likelihood of this kind of outcome? What would the impact be if it did occur to your circumstances? Because for some people, they could ride out this scenario without it touching the sides. If you've got enough saved, well, it wouldn't affect your lifestyle.
And if you own your home outright, that would be a big help.
Yeah, and you have lots of cash or you have lots of assets. So even if they fall in value, you can still sell some and you'll still be able to live pretty well. But of course, that's the minority of people. Your average person would be negatively impacted by this. So it really depends on your circumstances as always. If you would be crushed by this kind of scenario, well, you should pay it more attention.
Is this kind of the realistic worst case? It's pretty comparable, isn't it, in size to the global financial crisis, albeit it's a very different scenario. We talked about how inflation is kind of moving in the opposite direction to what we had back then. But is this like the worst kind of supply shock scenario you would consider?
I don't think it's the worst. I don't think they could model that. And I don't think they'd be able to model that because it would be very difficult to work out the consequences. By using something which is kind of similar to what we've seen in the past, that at least allows them to calibrate their models. But if it was a very, very extreme outcome, so if Russia launches one of these Poseidon nuclear drones and we get a radioactive tsunami taking out London, well, how would you model that?
Will the bank survive, Romin? That's what I want to know about. Long cockroaches. But there's no point in modelling that kind of scenario, is there, really?
No, and I think you've got to understand the limitations of these scenarios because if they did model that, it would all be hopeless. So, there is no hedge against that kind of thing.
I want military planners to model that, not the Bank of England, Because otherwise, if you do model too severe scenarios, I'm not talking about nuclear war, but something where you've got like a 30-year Great Depression, stocks down 95%, housing market down 60% or something. Well, obviously the banks are going to fail that. Therefore, the regulators would say we've got to hold a bigger capital cushion. Therefore, lending will dry up. Even though there's not a problem right now, we might cause a problem by being too cautious.
Yeah, if you force banks to have really, really large capital buffers, they're not going to make a profit and they just won't be able to exist. So it's always a matter of taking a reasonable amount of risks and generating a good return in good times, but also having some money set aside for the bad times, but not too much, because that's a risk as well.
The big mistake is thinking that banking can be risk-free. By definition, it can't be. They're taking balance sheet risk, as you've said before. That's the business.
And if you start a business, you can't do that without taking any kind of risk. It's just impossible. So that's why you get the reward if you take a risk.
Okay, just to wrap up then. I think if a scenario like this happened, maybe it would be a bit like the global financial crisis. Some people would suffer a lot, but the great majority would suffer a little bit, at least in the short term. But the bigger problem is long term. Like you could say we've never really recovered, the UK I'm talking about, from that global financial crisis. It really was the turning point when you look at the graphs in terms of productivity growth, wage growth, and living standards.
Yeah, I think these scenarios underestimate the scarring effects of some of these crises. And that's particularly true for the UK, where we are an open economy. We do depend heavily on the financial sector to generate GDP. And like you say, we had that huge scarring effect of the GFC, which we haven't really recovered from at all. If you look at those graphs of productivity growth in the UK, it's just like a hinge shape, where after 2008, we just never got back on our feet.
No doubt we'll get back on our feet, and then this stress test scenario will come true.
Now, if you are worried about these kind of scenarios, a good place to discuss it is in our forums in PensionCraft, where like-minded individuals could tell you what they think of these scenarios and how to allocate for them. To learn more about that, just go to our website, pensioncraft.com/membership.
Okay, today's dumb question of the week. Are British banks too big? So this Bank of England stress test looked at the 7 major lenders. So that's Barclays, HSBC, Lloyds, NatWest, Santander, Standard Chartered and Nationwide. And they account for roughly 75% of lending to the UK economy. But collectively, is the UK banking system too big for the country?
It's certainly big compared to other countries relative to GDP. It depends on how you measure a bank. If you include the investment bank part, obviously that makes it much larger. If it's just the deposit-taking retail banks, well, that's a much smaller ratio relative to GDP.
Yeah, so I think if you look at just the deposit-taking banks, or that element of the banks, they're around 136% of GDP, based on the figures I've seen. Whereas if you include the broader banking sector and all the investment banking and everything, that's approaching 500% of GDP.
What always amazes me is how small the entire enterprise value of a bank is relative to other companies. If you look at the US, for example, even really large banks like JP Morgan are tiny compared to companies like Nvidia. But maybe that's the right way around to have things. Maybe the financial entities should be smaller than the entities which actually do useful things.
Yeah, you don't want your economy to just become an exercise in financial engineering, which some people say is kind of what happened to Britain in the lead up to the financial crisis, right? So I guess this concern about, are the banks too big? As you said, certainly the British banking sector relative to our economy is bigger than most countries in the world. We have a lot of global banks based in London. And is the fear here not really that they're too big to fail, but that they're too big to save? Like, if many of those banks ran into solvency problems at the same time, it just might overwhelm the state. We might not have enough firepower to save them.
I think that's the worry. And if you look at other countries like Switzerland, which has some really big investment banks, or actually less than it used to have.
Yeah, one's left.
And maybe that one's not going to be there forever. Well, it is a worry. It is a worry whether the country could actually sustain that bank in a crisis.
Maybe the classic example here would be Iceland. So if we said that the UK banking system is like 400 to 500% of GDP, in Iceland in the run-up to the financial crisis, it was around 900% of GDP. And literally the country couldn't afford it when those banks went under.
I think now there are different routes of failure. It's much more the case that it's going to be shareholders, bondholders, which are on the hook if one of these banks fails. I think one of the positive outcomes of the GFC is that banks are now not going to depend on the state for a bailout, or at least that's the idea.
Yeah, that's the idea, isn't it? But if you look at some of these British banks, and we mentioned HSBC, it's got complicated businesses all around the world, exposures to lots of non-bank financial institutions like private credit and hedge funds. They all do. It's really hard to unpick that in advance if you're a regulator.
And if you do have just a handful of banks in your country, major lenders, and one of those goes down, well, it's going to have all sorts of secondary consequences, which are very painful for the economy, primarily because you've got a big source of capital which has just disappeared. And if you're a business which depends on that capital, well, you've got less choice in terms of other banks you could go to.
It's also not great when your tax base depends too heavily on any one sector, especially not banks, which are cyclical. And I think the other concern is if you have a very big banking sector, there's a risk of regulatory capture where they kind of set their own rules. You could say that's what's happened in Switzerland, going back centuries, really. We did that podcast, didn't we, about the history of Credit Suisse, with Duncan Maven. And it
I
was
love
fascinating how Swiss bankers kind of built the country and then shaped it in their own image.
I don't think that's true in the UK. I think it's still the case that the UK is more diversified in terms of industries. So the UK economy is a service-based economy, and part of those services are financial services. But there are all sorts of other services which we provide, which come under miscellaneous. What does worry me, though, is that every time we run into a period of economic growth, which is a bit slower, people assume that if you just deregulate banks, it's going to fix the problem. Whereas actually what usually happens is it gives rise to a whole bunch of financial engineering down the road. And sure enough, you get another banking crisis, which effectively does the opposite of what you intended.
Do you remember when, notoriously, Gordon Brown stood up in Parliament and said, we've put an end to boom and bust? Was it just on the eve of the financial crisis? Having to bail out half the banks?
Yep, I remember that. And those are always the memorable quotes, aren't they?
Yeah, I mean, to me, that's kind of a hubris to ever think you could put an end to boom and bust. That's built into capitalism, really. And you have to prepare as if there is going to be a bust, which is, I guess, what they're doing with this stress test. And to just finish, like, are British banks too big? On paper, they're a bit too big, don't you think? But if they are going to be too big, you've got to make sure they're at least safe.
Are they too big? I mean, I think that we're actually very good at financial services in the UK. So for me, it's not an issue. Look, I'm an ex-banker, so I'm obviously going to say...
Make them bigger!
But it's something we are good at, and I think it's something that we should celebrate. But it's something that we hate to celebrate for some reason. So no, I don't agree that they're too big. I think that they're about right. But should they be bigger? Probably not.
Thank you for joining us for Many Happy Returns. Keep sending us your questions, no matter how dumb, at mhr@pensioncraft.com.
And do remember to check out pensioncraft.com for all the information about our membership, courses, and investment coaching options.
Many Happy Returns is a Pensioncraft production, co-hosted and executive produced by Romin Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.